UPS Guayaquil, and we are recording this video to reinforce or intensify our knowledge about capital structure and Modigliani and Miller proposition without taxes. So first we're gonna explain some basic concepts about the capital structure. We know that there are two types of financing, through debt and through equity. So debt or bonds is when companies opt for financing through loans or bonds issues. The investors retain the full ownership of the business, so they can make decisions wherever they want, or they don't have to respond to other ones. And the equity is when companies sell shares on the stock market or through a private offering. This type of financing distributes profits to its stockholders and distributes the ownership among stockholders. I mean, these shares makes wherever or a person who buy this kind of shares could make decisions because they are the new investors. Okay, so debt is about loans and equity is about investors. So let's start watching this exercise about the capital structure and how it is structured. Okay, because we have the assets of the firm, and we have the current and the proposed scenario or option. Okay, so debt, we don't have debt in the current option, so we just have equity. But the proposed, we have 50% of debt and 50% of equity. Then we have the debt equity ratio, which means that how much of debt we have in our firm. So obviously the first one, current position, we don't have any debt equity ratio. Okay, but in the second and proposed option we have obviously 50 and 50%, so that's why we have the debt equity ratio, which is the division of debt and equity. Obviously we have 50-50%, that's why the result is 1. The share price is just a price that we just put just for this example, and the shares outstanding, okay, the shares outstanding is the division of the assets for the share price, right? This is the shares outstanding. I mean, we are talking trash. I mean, the equity by shares outstanding, and this is for the proposed option. The equity through share price. Okay. Obviously, we don't have here interest because we don't have debt, but in the proposed, obviously we have debt, and that's why we have to pay interest for this loan or for this whatever bonds issues or whatever example it is. Interest rate is by 10%. Okay, so we go to the kind of 3 options in the market that it could be expected, recession, or expansion in our capital structure, in our current capital structure and the post capital structure. So we have in the expected, I mean, which we are right now. We have the equity, I mean the income before interest and taxes. Yep, and the interest obviously we don't have in the current. That's why we don't have anything right here. So we obviously have the same thing for the three options: expected, recession, expansion. But what it change is if we have a recession, we have income lower than the expected and even lower than the expansion if we grow up. So for the expected we have 50%, for the recession we have 44%, and for the expansion we have 56%. The equity per share is how income or how it represents the income in our shares outstanding. That's why it's the division of net income by shares outstanding. So we have that per share we will have an equity per share by $5, and we have a recession we will have 4.38 and for expansion we will have 5.63 dollars. But when we have if we analyze the proposed capital structure with debt, we can see that our return on equity will be higher than without leverage, as we explained already. And obviously what it's optimal in a structure or a value or in a firm is that it has to be higher the debt than the equity. Even though, although it depends because of the firm and the market and other factors that it could change this theory. So as we can see, our return on equity is higher, and obviously the equity per share it will be higher, even though the shares outstanding is lower than the current option. You see about this 80,000 and 40,000, but the equity per share is 9. It's 9 instead of 5. And for a recession, even if we have a problem in our structure or in the market, our capital structure, if we have leverage, won't be affected. It will not affect at a higher proportion, because we have here 4.38 and we have here 7.75. But in expansion option, yes, there are a lot of difference, because in the equity per share it's 5.63, and for expansion in the proposed option it's 10.25. So it's like the double. That's where we can see that it's more optimal, or it's better to get leverage in our firm. Yeah, this is just for the really short introduction about what we're gonna speak. We're gonna explain about the proposition of Modigliani and Miller, the proposition 1 and 2 without taxes. So this is the proposition. Well, it's pretty easy. I mean, and the first proposition says that it doesn't matter how much debt we have or how much leverage we are, the value of the firm, it will be the same. That's what we can see in this graphic, in this picture. I mean, it doesn't matter if we have 80% of debt or 20% of equity or debt 50 and 50. The same of the value of the firm will be the same. You see, the 100%. It will be the same if we include or we don't include the leverage, the debt. Okay, that's all where we can say about the proposition 1. So there's gonna be a little difference in proposition 2. It says something different, but we can say that we're gonna resolve this example, and that's why we have a WACC of 30% in the first case. I mean, in both cases we have a WACC of 12%. I got a mistake right here. But the difference will be on the return on equity, because it will be lower if our debt equity ratio is higher than if we debt equity ratio is lower. I mean, that's what we're going to explain right now. So let's explain the example. We have here the Espadero Inc. had a weighted average cost of capital ignoring taxes of 12%. 12% is what we have. That's why we have here the 12%. It can borrow at 8%. RD, it's our interest. It's not our interest. It's the percent that we can borrow, and assuming that Espaderos has a target capital structure of 80% equity and 20% debt. So that's why we have this 0.25, because it's the division of 20 by 80, 0.25. That's our debt equity ratio. Okay, and what it says, where do we have, what is the cost of equity? What is the cost of equity? So we will gonna resolve this according to the M and M proposition 2. The cost of equity, RE, is this formula. Is what we have here. The return on assets plus the return on assets minus the return on debt. If I don't have a mistake, and the multiply by the debt equity ratio. So we have the cost of equity is the 12% of the with average cost of capital. RA is the same as WACC right here in this proposition. That's why we have the weighted average WACC as the RA, return on assets. 12% at a plus 12% minus 8%. That is the borrow, is the loan, 8% multiplied by 0.25. We have the result that is 13%. And for the second example is that what is the cost of capital? if the target capital structure is 50% equity. So we have the same, obviously, as we already said in another example. Our debt equity ratio 50% divided 50%, but 50% is 1. So that's why we have here the 1, and the result is 60%. So the proposition 2 states that as the firm raises its debt equity ratio, the increase in leverage raises the risk of the equity and therefore the equity return or equity or cost of equity. Kind of confusing, but what we say is that if we have a higher debt in our firms, in our capital structure, it will be higher the cost of equity that our investor will require because it's higher the risk. That's why we have 13% on our return on equity, because obviously everything or the most part of the value is equity. But if we have 50% of equity and debt, obviously the investors will require a higher percent, because they have more risk to arrange. And calculating the WACC using both answers, we have this. The 80%, right, multiply by 30% plus 20% multiplied by 80%. What is this? 80% is 80% is our equity. Our equity multiplied by the return on equity plus our debt multiplied by our loan, about our percent of loan. So we have in the WACC, in the first case, 12%, and the second one is the same, 50% multiplied by 60% plus 50% multiplied by 8%, it's equal to 12%. So it's 12%. So which state the M proposition 2? The M proposition 2 tell us that the cost of equity depends on three things: the required rate of return on the firm's assets, RA or WACC, the firm cost of debt, RD, and the firm's debt equity ratio, debt over equity. So, and in conclusion, we can say that the proposition 1 says that it doesn't matter how much debt we have, the value of the firm will be the same. And the second one tells us that as we increase leverage, the required return or cost of equity will be higher. The investor will want more. And that's all.